Good afternoon, everyone. My name is Stephen Abernathy, and along with my co-host, Matthew Daly, we're going to be your hosts today. Let me welcome you to the Abernathy Group Family Offices July 2025 First Friday meeting. And as we always remind you in this meeting, we're going to concentrate our efforts on the risks inherent in today's public markets. One of the obvious risks is it's clearly on the radar screen, meaning valuation. And, the public markets are driven, of course, by the technological advancements of AI, and they're real. We need to realize this. This type of technological advancement tends to introduce itself every 15 to 30 years. It's almost clockwork, and it's getting a little bit faster as this specific technology moves through the phases of adoption to getting to daily dependency. There's often an upset or maybe two along the way. While we don't advocate attempting to time the markets, we are firm advocates of avoiding overpriced assets because they offer little to no upside while providing significant downside if the future, which today really is priced for perfection, doesn't deliver perfection. So today, we're going to briefly compare the most recent world-changing technological event, the dot-com bubble, to the AI bubble we are in today. We're going to demonstrate, I hope we're going to demonstrate the excesses that can be created and the pain it can cause when investing or when the investing public chases overpriced assets. So over the last four First Friday meetings, we pointed out several times that the markets are priced for perfection, speculation remains abundant, and the policy continues to change rapidly. Historically, this combination of events has created a recipe for trouble at the very best, and at worst, it forces a significant repricing of assets lower as the earnings expected tend to fall short and the narrative starts to change from speculative trading, meaning the market always and quickly bounces off of these small declines, to the future is uncertain and it's much more risky than we thought. That's typically what sort of one domino falls into the next. So, as we said during the last conversation, today our prepared comments are going to be recorded, as other families who can't attend have asked us for the recording. Our comments today will be about 30 minutes long, leaving us plenty of time to answer questions from everyone on the call. And if questions or content creates other ideas or other topics, please feel free to type them into the chat box or raise your hand. And at the end of the prepared remarks, we'll click on you and we'll get to these questions, because this should be developing as a conversation, not as a monologue. So our intent was always to make this a town hall type meeting, and we realized that the topics we discussed today in our comments may create unrelated questions. So again, the primary goal of everything that we do here today is to ensure everyone's questions are answered. So, and all of we're a family office. We don't sell products of any type, and we don't have any incentives other than helping the families we serve make intelligent decisions. So we want to encourage you to send us your questions, and if others have the same questions or related questions, in short, it helps us figure out how and what topics to cover. So one final note, Please remember to mute your mics until you have a question or a comment. And by the way, if you haven't been to our website lately or our sister website, the Every Daily Consultants, there's we've been doing a ton of research. There's two or three really, I think, revelational papers that we produced, and they've gotten a lot of fanfare in the public uh, markets. So it's interesting. You might want to get there. Take a look. With that said, let me turn it over to Matt, who's going to oversee today's presentation.
Thank you,
Matt?
Stephen.
Yeah, man.
There's a lot to cover today, so let's get started. So today, as Stephen said, we're going to compare the dot-com bubble to the AI bubble that we are in today, with the hope that this comparison will help each family embrace realistic expectations for future investment returns and for the volatility which has historically taken place as new technologies are introduced, experimented with, adopted, and eventually become part of our daily lives. We're going to do our best to discuss where we are today and then talk a bit about the S curve, which has been proven to describe the adoption cycle for technologies over the past 100 years, with the goal of helping each family embrace realistic expectations for future volatility, both on the upside and the downside. Towards the end of the presentation, we will discuss some alternatives and hope to remind each of you about the adage that a bird in the hand may be worth two in the bush. So first, Stephen, where are we today? Are we poised to move higher as the world is world is a much less risky place geopolitically, or are the valuations seemingly prohibitive for those investors who are trying to make intelligent decisions by being value investors?
Yeah, thanks, Matt. So that's the question I think most of us are trying to answer. It feels like everyone's so sure the U.S. Federal Reserve will come to the rescue if we fail or if we fall down and if we bang up or skin our knee. That, if that's going to happen, maybe the risk should be discounted. We were talking with one of the families earlier this week who's on the call today and who was saying justifiably, things look like they've gotten a lot better. And I I I really agree. Things have gotten a lot better. So does that mean that we should start discounting some of the factors that could happen? And the answer is probably. So um, the downside could be replaced with upside when money keeps flowing into the market. And there's certainly some truth about this thought process. If you're going into a difficult situation and you have, let's just to play the poker analogy, if you have four aces in your hand, it makes sense to ignore the economic ups and downs taking place all around you. You know, and while our Federal Reserve represents the world's currency, it's not the equivalent to four aces in your hand. We're entering a zone of significant risk. The risk may not materialize. And in so many instances, most people think that it wasn't a risk. It's just not true. The risk is risk is all around us. Whether it becomes a reality or not is for the future to kind of let us know. Um, Yet make no mistake, we're priced at levels that only make sense if the world unfolds perfectly, just as our investing public expects it to. Um, Anything other than perfection, it's going to create pain. As you can see in the chart below, we're priced at levels which in the past have proven to be dangerous at best and disastrous at worst, because the fundamental earnings that support the current valuations, their expectations for these earnings, they're just too high. They're pricing in a future that sort of equates to perfection, and we seldomly get perfection.
So if the feeling is right and it seems like things are much better, why are you why are you worried about the market today? It seems like,
Yeah,
it does seem like we're in a better place today than maybe 3 to 6 months ago.
it does. Yeah. Um, I don't know. I'm always worried when markets start pricing perfection. There are reasons that the market tends to correct when valuations become absurd. And anything can be a sort of a tinderbox. I think oftentimes it's because intelligent investors stop participating when the market figures and then the market starts to figure this out. The narrative changes from risk on to risk off. And when this narrative changes, the investing public realizes that the returns priced into current valuations really do offer little to no appreciation. Um, so they sell and they go looking for alternatives. I think we're tiptoeing past that point today. That's the world according to Garp. It may not happen. It's not a timing mechanism. Keep in mind, as I said, this isn't a market call. As I should have called back and talked to the family that we serve that had this thought. You know, the world could stay at these levels and even move up from here, as we will discuss in a few minutes. I want to make sure we go over the positives as well as the negatives. Um, Liquidity really is abundant, and liquidity, along with animal spirits, those are the two most important and persuasive market drivers over the short term. And as you can see from the chart, current valuations are higher than even similar bubbles over the last 60 years.
Yeah, we can easily see those periods. Yeah, each of those periods lasted for several to many years. Can't this one last for years also? Especially since we have a big brother in the form of the U.S. Federal Reserve who is prepared to come to our rescue if we get in trouble.
Yeah, yeah, your statement's true, and history supports your thesis, and that is one of the futures that could play out, Matt. However, everyone who chooses to play this fire, with this fire, needs to know what history is offered. So here are some similarities. Well, we wanted we don't say that history is the future, but it's likely that it's going to rhyme. You've heard that saying before, I'm sure. So here are some of the similarities between the last technological change and the one we're going through today. In the dot-com bubble, we advanced over 5 times from 1995 through 2000 before reality struck. During that period, the market reached all-time highs and the economy was booming. Every company was spending huge amounts of money on internet infrastructure. In fact, so much that the narrative changed from earnings per share, and all of you will remember this, to eyeballs per share, which referred to the idiotic narrative that your website or your signpost attracted investors. And if you attract investors, they'll come and then they'll spend money. So don't worry about revenue generation. Just worry about getting people to visit your website and record those eyeballs. As we said, the narrative was buy more stocks every time there's a dip, and the world has changed. So don't apply the old rules of valuation. I don't know. I might say those were some pretty famous last words. Matt, if you have anything here to add, I'd love to hear it.
Yeah, just on the comparison aspect, I think just to remember because it's easy to forget these things, but the AI boom reminds me of the .com, and I think one of the things to caution for is that some of the companies that were the biggest, most valuable, internet startups, if you will, even if they were large already during the .com. I think Yahoo or eBay, both of those actually still exist, but they're shells of what they were back then. And I think even some of the big AI startup names now, I think at least one of them is going to become a loser at some point, even if it looks like it's going to be number one right now.
Yeah,
So
don't
I think
forget
that's something
AOL
to
was the
read.
standard bearer. Remember?
Yeah.
Yeah,
So I think that is likely to happen again.
yeah,
Not to mention the existing companies that are out there, even large companies that could make a mistake on it. I think I read a quote. I think might have been the NVIDIA CEO. I can't remember exactly who it was attributed to, but it was a good quotation that said, it was easy when you were a startup and you had no money. You make good decisions.
yeah, yeah.
But even companies that are well established, the quotation said the more money you have, the bigger mistakes you can make. So some of these big companies that are investing in AI, if they do it the wrong way, there's some risk there as well.
Definitely. And when you have lots of money, your guard tends to drop. It's just natural. It's human nature.
Right.
Anyway, so here we are today. As you were saying, Matt, there are lots of similarities. Um, in that the market's up hundreds of percent over the last 5 years. Capital spending or capital expenditures on the infrastructure build of AR, of AI, they're approaching $1 trillion, a number that I want to make sure that you guys understand. Back in 2000, I don't think $1 trillion, I don't even think that was a word or a phrase. You know, it hardly existed. As at that point, I remember billions being a significant amount of money. It's just funny how inflation works silently in the background over time, and when we have a government that is damned and determined to continue to throw money out, um, it's inflation is the silent thief. Anyway, the AI narrative is that it is going to change the world, and we believe it. I think, Matt, I'm going to leave that up to you to disagree, but I believe it will. I believe it'll change for the better at times, and maybe for the worse at times. It's going to be a world changer. It's worth paying but I guess what I would say or ask you is it worth paying hundreds of times future expected earnings for when those earnings are based on, I think, thin air? We don't believe so. And as we've stated in our last few presentations, today the narrative is that profits are not important. Building the models and owning the data, that's important. Data tends to be the new currency. So, in short, the investing public has all but forgotten about the economic model represented by something that all of us technology guys are familiar with. It's called the S curve. And it's not a new model. It's one that's played out time and time again, but the last time it came into play was right around 2000. And we tend to forget about it. That's a generation ago. You know, while a few, and while I should say that differently, while few futures in life are guaranteed, the S curve has a very high probability of occurring again. Matt, any comments on that one?
No, I agree. Nothing to add there.
So this slide shows the classic S curve. What it tells us, or what it does, is it documents the technology, whether it's the car replacing the horse, or the semiconductor replacing the typewriter, or the computer and the internet, and every technology cycle. There is an introduction period, there's a testing period, there's an adoption period, and then there's a period where everything slows and humans try to figure out how to use this technology in a way that makes life easier. And it's often this period after the fast growing introduction period where few are using the technology. So the comparisons used by the supporting industry tend to show that the growth is out of this world, meaning that the denominator of users is very low, and it it sets you up for huge growth numbers that people are hanging their hats on, and they're thinking it's going to continue forever. but it doesn't because the denominator grows and, and users grow, but the denominator grows so fast that it just shows slowing, and that it shows that the stupidity, people expecting hundreds of percent a year forever, are just wrong. Anyway, when the slowdown comes and the comparisons become much more difficult, and we're going to get there at some point. However, here's where we are now. We're in the adoption phase, and we don't know how long it's going to take the world to become addicted to AI in a way that they're addicted to their computers and their phones and the social media today. These periods often take a decade. And at some point, there comes the reality that our expectations in pricing the future have become too high. Let me just add a real quick comment. I still don't see any new revenue being generated, new appreciable revenue being generated by any of the AI technology yet, meaning revenue generation. I do see that there's lots of back and forth about becoming more functional, about becoming more efficient. So efficiency, probably new revenues. I just don't see it yet. And this is going to start, it's going to start hitting the wall at some point. Matt, any comments?
Well,
Well,
just
yeah, go ahead.
when our expectations have become too high, what happens then? When the realization confronts us that the technology is great, like you said, it's world changing, as you said, but it's going to take time, maybe a significant amount of time for it to really be integrated into our lives and become an everyday
Yeah,
kind of value add for the
yeah,
majority of people.
that is exactly the right question. You nailed it. I mean, we don't know for sure. We don't know that, you know, for certain that the S curve is even still in play. It seems to me that AI is being adopted faster than some of the other technologies in the past. But I'm just telling you, everyday people, that aren't part of the programming world, they are still intimidated by AI. They aren't using it every day. We had our first Friday meeting a while back, and we cautioned everyone and urged them to use it every day. Just force yourself to use it. Some people are using it more often, but they're using it for search, as a replacement for search, and that's not going to cut it. That's not going to generate revenue. So we don't know whether the S curve is still in play, yet it's still a very solid economic probability. And here's what usually happens. We wake up and we find that our expectations are much too high. The vast majority of our investing public has overpaid for a future that may well become, it just may not come to pass. Yet it's going to take some time, and everyone realizes at the end that they've gone too far. In short, they may very well have become Wiley E. Coyote.
Current valuations seem to imply that if this happens, there will be some losses, and given our debt, the losses could compound on each other. How could we avoid this disaster? Can it be avoided? Meaning, is this just typical technology cycle?
This is the topic that one of the families, called up last week, and I missed the conversation, but the implication was exactly this. Um, Matt, you described it pretty well, and no, most of these technology cycles and the economic cycles can't be avoided, yet they can be muted. And if the Federal Reserve comes to the rescue, like they have over history, these kinds of things can roll past us without even um, any indigestion. So, however, this has some significant long-term downsides of its own. And I know I'm not. Please don't get mad at me for always bringing up the downside of this. I mean, I'm a fiscal hawk. I worry about our debt. Um, Yet the point is that this cycle is more likely than not. It's in play now, and it's largely to be muted. It's likely to be muted by the U.S. Federal Reserve as they stand. I think they stand ready to rescue us from every single downside. I, I think I think that's a fact, and I think the incentive dictates behavior that says that the U.S. Federal Reserve wants interest rates lower, certainly on the front end of the curve where they can control it. That is going. It seems like their incentive is to bring that down. The problem is going to come if they bring the front end of the curve down and the back end of the curve increases in interest rates. That's when we'll start to know that the end is nearer than we think. Additionally, I want to make sure that everyone knows that we're looking at both sides of the coin. There, there's another layer of protection that's in the works. Take a look at this slide. The most recent bill in front of Congress, labeled the Big Beautiful Bill, it promises to increase our deficit as much as the former administration. The reason I bring this up is that if our government continues to spend 6 or 7% of our GDP, that's more than we make. And if we can continue to grow our economy at 2%, understanding that we're spending 6 or 7% more than we're making, we're technically in a recession. We just never have to realize it. Um, and this is unsustainable. You've heard that word a million times. I'm sorry to bring it up again. If we can do this forever, we never have to change our ways. But I think that's foolishness. Um, we never have to use common sense, and we never have to use to live within our means until we become Argentina, and the world makes us live within our means. Um, if we get to that point and we need a Malay to come in here and change our world, um, that's going to be disastrous. I mean, past fear. Yet that's not where we are today. Matt,
Why do you think that we can just continue down this path for an indeterminate amount of time and be okay?
I had with the world's currency, I don't know. It seems to roll off our shoulders at every turn. I mean, I do believe that our status as the hegemon and being the world's currency, it's not about to change over the next few years or maybe even longer. And additionally, we've saved up enough dry powder to keep the narrative from the talking heads going for a while. Take a look at this slide. Here's a slide that documents the amount of money sitting in money markets. I think that money is confused about current valuations. Maybe they're confused about the activity from our current administration, and they're just not able to figure out whether they should give up their 2 or 3% guaranteed returns in the money market or move into overpriced stock market and risk a 50% or more downturn for the 10 to 15% return experienced over the last 5 years. So don't forget now, there's a fair amount of recency bias factored in to this thinking or to this logic, because the last 5 years, the market has compounded at about 15% a year, which is off the charts. it's not sustainable. Um, and I think this recency bias is in full gear today. Um, and I do want to tell you that recency bias tends to make people make bad mistakes or bad decisions, and it tends to end badly. So, suppose the US Federal Reserve comes to the rescue and starts lowering interest rates or pumping money into the economy. And in that case, it's pretty likely we're going to avoid the cleansing needed that comes with a recession. And again, I'm not trying to be political and I'm not trying to be a recession monger or a class F empty guy. I'm not. I'm just saying that recessions have a purpose. They're there is a lot that bad that happens, but there's some good too. Um, the bottom line is we could definitely avoid a recession with the amount of money sitting on the sidelines waiting for any dip. Yet this is where it might get a little bit interesting.
Yes, if all goes as you described, I'd agree that there's a pretty good chance we'll be able to avoid disaster. But what happens if the increase in wages and the increase in tariffs are passed along to consumers, which in turn would increase inflation? And then what happens if our GDP does start to decline, which would bring stagflation in our future?
Oh man, that's a world of hurt. So here's a slide about that. So that brings us to a different type of economic environment that we're going to have to deal with. And this is one type of future that becomes imposed upon us because our debt levels are such that we're spending a significant portion of our revenue to pay our interest expenses. We can't allocate funds to growth initiatives that will enable us to grow out of our debt. Besant keeps forecasting 3 3 3s. He wants us to grow 3%. And that's a great, I mean, that is a prescription for delaying the inevitable. But I don't see where we're going to have the money. We're now borrowing money to pay the interest on our debt. That's usually the beginning of the end for an individual. So anyway, we can't allocate funds to growth initiatives unless we have the revenue to do that. And that's the only way we're going to be able to grow out of our debt. It's a problem.
If we can dodge the S curve downturn, could we sail through the economic rainy day and make it to the other side, do you think?
I don't know. Here's a slide that allows us to sort of think about what the known knowns are that are in front of us. These are my fears that we're trying to deal with. So um, this slide allows us sort of to think about all the risks that are in front of us. If, as you say, Matt, we avoid the S curve downturn and we sail through a slowdown period. If the nearly $1 trillion spent to build our AI revolution starts producing real revenue, these are the things we're going to have to deal with. So first, it's unlikely yet possible that the Iran-Israel conflict is over. History tells us that there may be a lull, yet this is not over. It just morphs into a different dimension. And Matt, you're much more on top of this than I am. If you have some comments, I would welcome them right here.
Yeah, I think it's unlikely that it's over. I think it is likely that, or is more than possible that launching missiles back and forth at each other is over, at least for the time being. I think it more than likely will morph into some kind of technological warfare. And it doesn't necessarily have to be a direct retaliation to Israel. Iran's enemy is the West. So it could happen in any European country, it could happen in the United States, or it could happen in Israel. But I think there's like a high likelihood there would be at least an attempt at some kind of critical infrastructure attack or random terrorist attack by via proxy in the near future. And then I think the more concerning one is that Russia, Ukraine seem to be going towards resolution, and then now it seems to be drifting in the opposite direction. Um, I think
Yeah.
the main thing to watch out for is additional conflicts popping up before these are able to be resolved or at least cooled to a level that is not as risky to the global economy and global security.
Matt, earlier this week, I know we talked about cybersecurity, and you were really worried about that. Is that still bumming you?
It is. I think it's probably one of the most likely ways that um, we get attacked by enemies. It kind of, in a way, not so much. I'm sure it takes a lot of investment and talent, but it levels the playing field a little bit where a smaller, weaker country that maybe doesn't spend as much on military, raw military materials, missiles, bombs, personnel, has a better chance of attacking the United States and having a bigger impact than if they were to try and do an armed conflict. But yeah, cybersecurity, I think will be the new wave or new era of warfare that we will experience in the next several decades, only more advanced attacks. And I think, I mean, I know these cyber attacks happen very common now, but one major cyber attack and every cybersecurity company is going to go up 10 times.
Yeah,
It's just not
it's
something that
true.
most people take seriously or think about right now, but one attack away and all those companies will explode.
Yeah, and I think it's one of these. I think it's one of the categories of investment that will end up enduring past the AI um, cycle, the S curve. But let's move on real quickly. But we've we've not mentioned some of the known knowns that are worrisome, and student loans come to the front of the class. I know that these things, everybody thinks that they're um, forgotten, and I think that might be a little bit. I think that might be a little bit, whistling past the graveyard. The vast majority of investors haven't followed the student loan process, and today the U.S. government, they've created a monster of an asset class that really has become a significant challenge if it can't be repaid. It is as large or larger than the real estate crisis back in 2008. Here's a chart showing what's taken place over the past 19 years. Today, we've got a trillion 700 billion in student loans outstanding. This could be an accident waiting to happen. So, I mean, the question is, can the young people who've borrowed this money for a degree in European history or 17th century art pay these loans back?
I know you're not trying to demean these degrees in any way. Those students, I'm sure, worked
It's true.
hard to get their
I'm
degrees.
not. They have. I get it.
The real question is, will the degrees allow them to translate their education into a career that will ultimately allow them to repay those loans?
And I think the answer is we aren't sure. I know I know story after story after story of people with degrees that we just mentioned turning into brilliant entrepreneurs. It's the truth. They're just motivated, they're educated, they're as smart as the day is long, and they're just they're brilliant people, and they go on to become incredible entrepreneurs. But we just don't have any history on the student loan payments. What we do have, because I'm a little bit of a nerd on this, is we do have a chart that shows the lack of payments, and it's concerning. Let me take you to this chart. Here's a slide that shows the state of student loan payments. Let you take this in just for a second. And if you're watching and you're looking at this chart, you're going to see something that we're incredibly worried about. And here it is. I haven't seen a change in delinquencies like this in a long time. And it doesn't mean that the world's coming to an end. It doesn't, it, however, it does add another potential bump in the road that may cause a recession or a downturn or at least a change in the narrative. Other worries, Matt.
Yeah, are there other worries out there?
Yeah, there are, and here's a couple. We'll just rush through these. Um, here's what lots of economists call soft data. Um, it doesn't have anything to do with timing, and it doesn't say that we're nearing a downturn or not. It just says that asset values are too rich. Here's one. Um, it's worth tracking. Insider buys and sells said, you know, they're they're just saying that the market isn't worth. They'd rather have their money in a money market than they'd rather have it in the companies that they own, and they know these companies pretty darn well. So it really is worthy of understanding why they're doing this, and we don't know why. Here's another one. When the market becomes concentrated, it's saying that just a few stocks have come or they've become so large and they're appreciating at a very unusual rate. This typically signals that the market is overpriced and it just needs a reset. It's another diplomatic way of saying we're in for a downturn at some point. No, we don't know yet, but these are soft pieces of data and they're worrisome.
Each of the topics you just mentioned are historically indicators of caution, yet none of them give us a sense of our future returns. Are there more reliable indicators that can give us set or help us set our expectations for future returns based on our current valuations?
Yeah. This is a chart we used last month, and it's an incredibly reliable slide because of the number of data points, making it statistically significant. Um, with tons of information we have on it from this is from the excellent analyst John Hausman. Um, he, you know, he does excellent research, and each of you on this call, if you can, just Google him. Um, the research that he does should be followed very, very closely. He's just a data guy, and he's not a hypester, and his work is really, really good. So this is a chart that couples current valuations with subsequent 10-year returns. There's a lot of explanation behind this that's important, yet for this call, all you really need to know is the bottom line. And that's as valuation increases, future returns fall. Currently, the I guess the short note on this is currently we're at a level of valuation that says investors in the market today should expect a return of negative 2% per year on their money for the next 10 years. And believe me, this information is statistically significant. It's not a timing note, it's just, and it's not a guarantee of returns. It's just it's just more likely to be accurate than most people think. And if you ignore this information, you're taking some significant risks that you may regret. That's all.
Okay, that concerns us. What are some ideas that could provide shelter during the storm? Or where might we find some returns that are a bit higher than negative 2%, since that doesn't seem super appealing?
Yeah, it's not. I agree with you. I'm not chomping to get off the phone and go find some negative 2% returns. Um, Here's a slide that just reminds us of what categories of company have underperformed over the past few years. Um, and we want to emphasize that the value of getting paid while you wait. So our all-weather funds and our all-weather allocations have sort of emphasized the way real estate investors get paid rent as they wait for their real estate to appreciate over the years. And that's been a reasonably consistent, low volatility type of investment over time. It's overpriced today, but that's okay. Um, it's truly an underappreciated strategy that our family office has been advocating for more than the last few years, and the market's starting to come around to this. You're starting to see more webinars, more articles, lots of articles dedicated towards high quality dividend paying companies that are dedicated to paying investors with both dividends and with stock buybacks. Um, and they tend to deliver performance that's nearly equal to the fastest growing companies in the world with less than half the stress. Take a look at this chart, Matt. So here's a chart that dates back to 1971 all the way through 2005. And 71 is not a magic number. It was just a date that I could find for us. What this says is that NASDAQ, the fastest growing of the fastest crazy companies that don't pay any dividends, delivered a return over that period of about 10.7% per year. And the utility index, the most boring, staid, uninteresting sector, delivered about the same return with less than a half of the volatility and the drawdown. Not to mention the fact that we have talked about for the past couple of weeks or a couple of months, I guess, that the energy levels being demanded by the data centers and the EVs, they tend to make the utilities less of a staid, boring concept and more of a growth story. As most of these utilities, they can't supply the growth that's being demanded. So, with that said, I just want to remind people that what used to be staid and boring might not be staid and boring for too much longer. And in the meanwhile, um, as we've said before, a bird in the hand may very well be worth two in the bush, you know, regarding dividends and stock buybacks. Matt, any further or closing comments from you?
No, no, that's it. And I don't see any questions in the chat box.
Okay. With that said, we'll be back in August. Enjoy the summer. Call us if there's anything that's on your mind that we brought up that you wanted to talk about personally. And onward and upward. Bye now.